As markets continue to move higher, make new all-time highs, and as this upside capitulation really sets in, Tom Lee is out on CNBC with a new interview that I think you should hear. Tom Lee says, in fact, it's not really the macro that's driving the markets anymore. It is just the sheer amount of cash on the sidelines starting to be put to work. And that kind of proves my capitulation theory. Because again, if macro does not matter, if the economy does not matter, people just want to get invested into markets, that is upside capitulation. And as I believe it's Warren Buffett says, the markets can stay irrational longer than you can stay solvent. You sure don't want to fight this market with your money, at least. You don't want to short this market, but eventually this capitulation is not going to end well. You can imagine this economy, if you will, as a teeter-totter. It is not consistently good or consistently bad. It fluctuates, and right now Wall Street just believes it's going to be good forever. It's going to be great forever, even though there's clearly signs that things are slowing down. Just look at company earnings. I mean, they're not spectacular. Now, JP Morgan and Wells Fargo, two of the biggest banks in America, they had decent things to say about the consumer. Wells Fargo says the consumer has slowed down a little bit, but still remains overall okay. JP Morgan says the consumer is steady and on good footing, but those things change quite rapidly. In fact, take a listen to this short clip from CNBC that says consumer spending actually fell for the first time over 7 consecutive months. It has been positive, and it's a pretty sharp fall at that.
Right now it's time for a read on the consumer. Steve Leisman joins us with the latest results of the CNBC NRF Retail Monitor. And Steve, what'd you find?
Becky, it looks like consumers have taken a break between the strong holiday spending season, strong summer season, and the holiday season, with the CNBC NRF Retail Monitor registering a decline after 7 straight months of gains. The Retail Monitor, powered with actual credit card spending data from Affinity Solutions, shows spending down 0.3% when taking out auto and gas. That followed a half-point gain in August. Spending grew 0.6%, a meager 0.6% year over year. Taking out restaurants, what we call core retail, shows a similar 0.3 decline and a 0.9% year-over-year gain. The decline was broad-based, with only 3 of our 12 sectors showing any gains. Take a look at some modest gains in there. Non-store retailers, that's digital sales, up 1.6%. Clothing and accessories up 1.1%. You may remember there was quite a bit of inflation in the apparel numbers yesterday. Health and personal care, a meager 0.04% gain. Gas stations were down. Furniture and home furnishings were down, along with building and garden supplies as well. Our initial read of the data is that it was too early to pick up any effects from Hurricane Helene, though there could have been some impact at the very end of the month. Hurricanes, of course, can boost spending ahead of a storm's arrival, for example, in building supplies and food, reduce them, and then see them increase somewhat again as rebuilding begins. If it wasn't the storm, well, it leaves open the question of what prompted the drop. Spending has been relatively robust through most of the year, but weakened a bit from August. In August from July before turning negative this month. Economists have been forecasting a spending decline in the aftermath of the pandemic that hasn't really appeared yet. Well, NRF economist Mark Matthews tells me September is historically one of the weakest months for retail sales since it's sandwiched between big summer spending and big holiday spending. October numbers will probably have some real impact in there from both Helene and Milton.
Now, did Wall Street pay any attention to this data that came out on Friday? Absolutely not. Again, because we are in this upside capitulation phase in markets where people are just saying, forget what the data says. The markets are up over 20% this year. We're not going to miss out on another 20% rally next year. And again, that's not a guarantee that's going to happen. That's just the thought process, the emotions behind how investors, big money that moves markets, are looking at the current state of markets. After all, there is a bias to be positive, to be optimistic, to have a, positive, forward expectation for everything, for life. People tend to be optimistic in nature, and it's no different in markets. Now, also take a listen to what Tom Lee just said about markets, and he makes a lot of very interesting points.
Let's welcome in Tom Lee, Fundstrat's managing partner, head of research, also a CNBC contributor. It's good to see you on this Friday. Welcome back, Tom.
Thank you, Scott. Great to see you.
I led in here with the fact that, we have this streak going for stocks. We above 5,800 for the S&P for the first time ever, though it seems to me from your notes that you're a little bit cautious as this month progresses. Why?
Well, Scott, we're cautious, but we advised our clients to be buying the dips. And the reason we're cautious is that I'm probably saying something very obvious, but I think investors want to see who ends up becoming president after election day. So I think we are in a period where markets are just sitting on the sidelines, but at the same time, 2024 has been such a strong year, Scott, that I think the last 2 weeks have proven that maybe macro is taking a little bit of a step back now, and liquidity and all this cash on the sidelines is really the dominant factor.
You think we just have to get the election out of the way, and then it sort of clears the way for what you still think can be a pretty decent rally? I think your target's 6,000 or around that.
Yeah, Scott, there's a lot of firepower supporting stocks post-election, because we've got a Fed that's dovish and the economy looks healthy. I don't think we're in a recession. And so, the 3-month and 6-month outlooks are very strong for stocks. And I think China, while there's maybe some hesitation, but China's government is really starting to unleash some measures, and that's supportive of that region finally turning. And of course, the third factor is, I think after 2 years, investors who've been very cautious are starting to realize that, the $6 trillion of cash on the sidelines and the low levels of margin debt need to be put to work at a time when the Fed is supporting the economy.
The other possible headwinds, I think, are ones that are maybe outside of the political cycle, at least as people, refer to them. Valuations, they say, are too rich or stretched, right? The S&P is about 21.5. That's above, obviously, its historical average. Yields are up. Now, you could make the argument that they're up for the right reason, but I think they're still up a little bit more than people thought they might be after the Fed did its 50. And then if the Fed's going to be a little bit slower and smaller in the way they progress with rate cuts, is that an issue? Of course, the flip side of that is, well, why would they need to do anything anymore anyway? Because the economy is as resilient as you just suggested it is.
Yeah. Well, on all those points, Scott, on valuation, I know people use the aggregate number for the S&P, but it is misleading because, as we know, the top 7 stocks do have a higher deserve multiple, and the median PE, it's not that much cheaper, but it's around 18 times. But that's not a bad deal considering the 10-year yield is actually a 25 PE. And with regard to the Fed cuts possibly slowing, I think what really matters now is the Fed is on a path to essentially normalize interest rates back towards neutral, because the inflation pressures are ebbing. I mean, I think even CPI this week, even though it was a little hotter than expected, really didn't send a signal that inflation's reaccelerating. And so the Fed is, on a path towards 3%, and I think that's really constructive for stocks.
Keep in mind, Tom Lee also has a 6,000 price target on the S&P 500 by the end of this year, which would suggest Tom Lee believes the S&P can rally another 3.5% or so between now and December 31st. Honestly, again, just doesn't sound very attractive. If you say we have max upside of 3.5% between now and the end of this year, but potentially a correction coming, again, seasonal corrections, election corrections, like those things are normal. That doesn't look very attractive in the super near term. Now, if you don't care about timing the markets at all, you just buy whenever you get your paycheck or whatnot, then, don't worry about this. No problem. Just buy and hold for the long term. If you're a little bit more tactical and you believe there's better times to invest more, times in which it makes sense to not invest as much and wait for a better buying opportunity, then you can also choose to do that. I think this is personally one of those times where it makes sense to look for a better buying opportunity given the risk that we have out there. If the economy was truly doing great, the unemployment rate was falling, then I would say now is probably a great time to be investing, to investing more, right? You should always just keep investing, but to invest extra, to invest more, I don't think that's now. But after this clip from Tom Lee, I will share with you the areas that I do think have a lot of upside. As Tom Lee says, the median stock in the S&P 500 is only at an 18 times earnings multiple, which is not cheap, but it's not as bad as the over 22 times multiple the market cap weighted S&P has today. One of the big problems that we are facing in markets is actually geopolitical conflict because of the implication for oil markets. Oil going up has a negative impact to the economy, thus can affect consumer spending behaviors, can actually impact consumer spending on a dollar amount. Just even a relatively modest spike in oil can become a large problem, let alone if oil were to spike large, that would be devastation for the U.S. economy. So there's anywhere from this is nothing, it's not going to impact the economy, to a black swan event that completely throws us into a deep recession. These are all possibilities from this geopolitical conflict. Now, here a couple of hours ago, this news says Israel poised to strike when commanded, according to U.S. officials. And this is really the news that should have markets a little concerned. It says U.S. officials describe Iran targets as military and energy. So if there's any kind of disruption to the oil markets, we're going to have a big problem on our hands. Now, with that said, I do think there is opportunity in this market, believe it or not. A lot of the stocks that have opportunity are the unattractive, the unsexy stocks. These are a Dollar General, Humana. These are CVS, I think, still has some value left in it. Some healthcare names, industrials, cyclicals, small caps, Tesla, right? The companies that have not performed as well over the past couple of years that are tied to economic developments, tied to economic activity, those are going to be the ones that benefit the most if we actually do have a soft landing. I mean, Dollar General, do you think they're going to benefit from a recession? Absolutely not. Do you think they're going to benefit from a stronger than expected economy and consumer? Absolutely. And just go down the list here. Besides Humana and insurance, I think there's a lot of value in cyclicals, and a lot of these names you can get dividends on. If you like energy right now, Kinder Morgan's a great example. It's trading below a market multiple, about 18 times forward earnings, 16 times next year's earnings, with a 5% dividend, and it looks like earnings are going to pick up even beyond next year for multiple years. They got 75,000 miles of pipeline. Like, there is a lot of those attractive opportunities out there, but it's not in the headline S&P, and it's really in the areas that are already kind of priced for a recession, which then it makes the argument, does the rest of the markets eventually price in some recession risk? And that depends on how the economy evolves and how the economic data really performs over the next 5 to 6 months here. As I've said before here on this channel, I don't think we can declare a soft landing at least until April of 2025, at the earliest. If the economy is still doing fine in March, so economic data from March, we'll get that reported in April. If the economy is still doing fine by then, if the unemployment rate is going lower or trending around the same level where we are now, then I think you could make an argument that we did achieve a soft landing. But consensus being a soft landing by a long shot right now, it is far too early to make that conclusion. And I think you want to position in the areas that will benefit from a stronger than expected economy. And unfortunately, that's not big tech. Big tech will do well if the Fed stays higher for longer. If the economy is weaker, but not quite recessionary, that's big tech's Mag 7's wet dream, if you will. Now, for the Uber Bulls out there, we did get some reinforcements from the Friday new all-time high. You did get a pretty aggressive breath thrust in our markets. You did see about 9.5% of stocks break above the 50-day moving average on Friday alone. That's a pretty damn big jump, okay? It's not something that you tend to see all the time. You're now sitting at almost 64% of stocks trading above their 50-day moving average. And again, I gotta say, that is a good sign. Although the markets do look eerily similar to 2007, as I explained previously in this video, markets, or in other videos, I should say, markets have done exactly the same thing in 2024 as we did in 2007. We hit a new all-time high the same day in the summertime. That was back in July in 2007. The Fed cut rates 50 basis points on September 18th, 2007. That's exactly what the Fed did this year. They cut 50 basis points on September 18th. Markets went on a rally following that for about 3.5 weeks. Same as happened in our markets. And you hit the all-time high on October 11th of 2007. Friday was October 11th, 2024, and you hit a new all-time high. If this pattern, this weird set of coincidences plays out the same, then Friday would mark the high, at least for a period in time. Now, if it's a 6-year high like it was in 2007, I'm not going to make that bet, right? I don't think that the 2007, 2008, 2009 recession is going to be what we see in 2024. I don't even know if we will get a recession, but it could mark a period of more volatility for markets going ahead. I will also note that you did break above 580 on the SPY Friday, but you did not manage to close above that. So that could be a bit of resistance as we do get into earnings season with a little bit more companies reporting earnings this week. In fact, you were barely above 580. For the brief few minutes you were above 580, it didn't last. You fell back under 580 towards the end of the day in the last 10 minutes of trading or so, and you actually closed at 578.70. So $578.70, down about 0.15% in after hours trading. And over this next week, we are going to get company earnings from ASML, TSM, TSMC, whatever term you like to use for it, as well as Netflix and many others like banks and healthcare companies that will drive the next narrative for markets. As I've said for a while now, Q3 earnings is the most important thing for markets. It will confirm whether earnings are actually going to pick up or whether that was kind of a facade to begin with. Markets are expecting around 15% earnings growth for next year, although the estimates have actually been coming down for 2024 and 2025 earnings ever since about early September. So over a month now, about 5 weeks, you've seen almost every single day earnings estimates just trickling lower. And earnings estimates tend to guide stocks. So when you see earnings estimates fall, stocks tend to fall. When you see earnings estimates rise, stocks tend to rise. So let me know what you think about all of this information down below in the comment section. Hopefully you guys can understand some of the things that are being discussed here in this video, because I think they are important at a time like this. This is going to be a critical inflection moment over the next really couple of months, but it could have happened on Friday if 2007, the eerily similar, coincidences do pan out again. This could start a larger, broader rally in markets where you get this broad-based rally, or it could start a period of repricing if earnings do not come in as good. So again, let me know what you think about all of this information down below in the comment section. You guys have a fantastic rest of your day. Stay safe out there, and I will see you in the next one.